Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to Exec Chairman Peter Harris and CFO Iwan Phillips of Northbridge, which is soon to be renamed Crestchic at the AGM in June. So welcome, gents.
Hi, nice to see you, Paul.
Hi, Paul.
Well, massive congrats on today's excellent 2021 results, with underlying sales up 20% like for like to £29.5 million, and a strong start actually to the new year as well in Q1. So perhaps we can start there, Peter. Can you take us through what's been frankly driving this extraordinary growth?
Yeah, it's been a pretty special year for us. You know, you've been talking to us and we've told you the story right from the start of last year. A lot of change, a lot of focus actually on Crestchic, our core division in power reliability. And one of the features of last year, obviously, the exit from Tasman, our drilling tools division. And I think that focus has paid off. Yeah, we're fortunate to be in a strong market, and a market that looks like continuing strong for some time to come. But we're pretty confident we've significantly outperformed it. And in both directions, we both sell the equipment, but we also rent it out. And both the sales and the rental had very strong years. And it was pretty much across the board. You know, our mature sectors, marine, extractive industries, critical infrastructure, they all did well, really well in some cases. Data centers, which has been driving growth for several years now, just continued to kick along. And then we are starting to see the early signs of growth in the energy transition arena with renewables and cleaner fuels creating opportunities for us. So all around, it was just a really strong year for both sales and rental. And then rental benefited particularly from a little bit of bounce back from 2020 when the pandemic actually impacted on some of the major rental projects, and they've kicked back in strongly and continued, as you remarked earlier, in the start of this year.
I guess you're going to be a green, well, effectively officially kite-masked a green company as well, aren't you, Peter? Because you're now doing renewable energy, and it must be quite a big part of all driving that growth.
It's definitely something we'll be looking to as a driver for growth for the next few years. I think it probably looks now like data centers did 5, 6, 7 years ago, relatively small in the overall mix of things, but growing quickly off that small base. And I really hope, you know, when we have the conversation in 5 years' time, well, you know, energy transition will have been the new data centers, and it'll be up there as a very significant part of our revenues. And yeah, and we spent a good deal of time and thought in 2021 looking at the whole area of ESG and putting in the sort of platform for an ESG plan, partly driven just by being good corporate citizens, looking after our environment, looking after our community, looking after our stakeholders, partly identifying opportunities that will come to us to use our technology as energy and power generation changes.
Good. Well, I see also you've done a fabulous job on the numbers there, because you've not only sort of like increased the top line by sort of 20%, but the margins, the gross margins ticked up a couple of percent. And that translated to an enormous increase in the return on capital employed. So what's been sort of driving that? Is that mix or what's been causing it?
It has been mostly mix this year, Paul. We've seen higher as a percentage of the total revenue move from 47% to 53%, mostly driven by the return of larger rental contracts, as Peter's already mentioned. And this has driven the margin up from 45% to 47%. We see great drop-through rates on that. So on the sales side, around 35%, dropping down. And on the higher side, before depreciation, it's been 75 to 80%. Obviously, that's driving the EBITDA forward. We will see an investment in staff and new depots in 2022, which will obviously take some of that drop through away, but building a solid base for the next phase of growth.
Great. Well, I mean, if you weren't investing, given it's a growth market, I'd be worried. So just on that theme, Peter, can you give us an update on that, the production expansion plans at Burton? Because it seems as though, because I remember you first talked to me about this and you were saying it was going to be sort of summer, and it seems to be getting closer, and you started with a 50% increase and now it's gone to 60. So all seems to be moving in the right direction.
Yeah, it's all good. It's all good. Yeah, we're anticipating being fully in production in June, possibly a week or so earlier. But the facility is looking great. I mean, it's up, it's built. We're now fitting out inside, putting the cranes in, putting all the power in, and it just looks fantastic. It looks as though it's been there forever, but it's brand new. And yeah, I mean, we did say initially 50%. If you look at the sort of footprint we're adding, 50% would sound about right. But we brought in a new technical director at the end of last year, John Storer, and he's done a great job already at looking at the opportunities to do rather better than just the sort of pro rata expansion on square footage. And we've seen the impact. I mean, it's sort of unfair to ask it of a guy when he walks in the door on December 31 and say, right, make an impact in Q1, but he really has made an impact. And we've seen a noticeable change in our manufacturing processes and a huge professionalization of our preparation for the new factory. And that's why we're confident that we'll get more than the 50%. We'll get at least 60%. And I'm sure John's got higher goals than that going forward.
Great. Well, it sounds like we're going to get sort of like hopefully some operating leverage and some efficiency. Have you managed to recruit the enough people to be able to sort of like staff this then?
Yeah, we have. That's a program that's been ongoing for about a year already. Chris Colworth started very early looking at that. And we've had to get quite creative because when we started the program, the world was still reeling from COVID. And actually, we got some really good people in that area because we were still doing well with some of the quite, big name industries around us in Burton-on-Trent were struggling a bit and laying people off, and we grabbed them with both hands. It's got tougher as time has gone on because industry has picked back up, manufacturing has picked back up generally in the Midlands particularly. So we've had to compete harder for people, but we think we've actually become a very well-respected employer locally. We do look after our people. We train them. We, make them welcome, and we have a fantastic record of retention. So what we've done is just get a little bit more creative, looking for the skill sets that we have around electrical fabrication and assembly. It doesn't actually have to come out of our exact sector of industry. There are people in other industries who have the skill sets we need, who've been quite quickly retrained and function very effectively in our environment. So yeah, we're anticipating being fully staffed by the time we start. The people will all have been through their training and induction. And we've dedicated part of the existing facility as a little training academy on site, so we can carry on with that training going forward. I think you'll have seen a little strap line in the results presentation. Yeah, we make a world-class product, but we want to be a world-class manufacturer.
Yes, I did see that, which is great.
It sounds trite, but it's actually really important to us. It's going to make a big difference, and investing in on-site training is just one small, piece of the jigsaw for that for us.
Great. And I see you're equally expanding on both sides of the Atlantic, because you've just sort of like, well, you're thinking about or have signed. Give us an update on the US, because it seems as though you've signed an agreement with, is it Mosback, is it, or locally in the States?
Yeah, there's two big initiatives going on in the States for us. One of which is we've opened a new depot in Texas. We're actually on site now. We haven't actually got all the equipment in, so we're not live in terms of sales, but we will be very soon. So we've got a new rental depot in Texas. Why did we pick Texas? Well, it's a very vibrant economy. It's got pretty much every one of our 5 sectors of activity is represented in Texas in quite a big way. Well, of course, it's Texas. Everything's in a big way.
I remember watching Dallas.
Yeah, absolutely. Didn't we all? Yeah, still got the hat somewhere. But intriguingly, Texas is right at the heart of the data center industry in the States. That's a sector that we've really only tiptoed around to date. And given that it's 30% of our total activity worldwide nowadays, to say that it's only a fraction in the States just scales up the opportunity. So Texas is a really important location for us to move into that market. In terms of what the market needs in the States, and this is why we've been small to date, typically the equipment is slightly different configuration and tech specs than you'd see in the European markets. And we had the choice, do we use UK manufacturing capacity to produce that different equipment? And at the smaller end of the product range, we just decided that was not a sensible use of our already constrained manufacturing capacity. There's some very credible manufacturers of equipment in the US, as you would expect. And we talked to all of them, and Mosbach was the one that firstly had the best fit for us, and secondly, just as importantly, was the one that was most keen to work with us. And we're really excited to have a first batch of load banks coming from them to set up the Texas depot. And we think that's a relationship that should grow.
Good. Is that building your fleet, is it, Peter?
Yeah, that's building higher fleet for us.
Yeah, okay. Fab.
Yeah,
okay.
Yeah.
Right. Just you, and now turning to sort of costs, how are you? So I know obviously everybody in industry was suffering sort of increased inflation. How are you seeing that, and whether it's easing at all going forward?
Yeah, we're certainly seeing it. Obviously, within the wages and salaries, as well as the component parts for our equipment. I think we're very fortunate to be in a growing industry that's very busy itself, and we're managing to pass those costs on to our customers. They're all in similar industries and understand that the costs are increasing. So we're managing to do that, and we are we're committed to looking after all our staff and making sure that the pay rises are appropriate. Good.
So, I mean, in terms of protecting the actual margins, it sounds as though, if anything, with the mix increase, they on underlying basis, they may even be increasing.
And that's certainly what we're targeting. Yes, and as Peter mentioned, with a new technical director on board, manufacturing efficiencies is something that we're looking at closely over the next few months.
Yeah. And then just on the sort of asset backing of the actual business, obviously you've got a lot of these load banks that I understand don't have much wear and tear. They're not like traditional plant hire equipment. We might have a power tool or a big drill, which effectively, sort of wears down within 3 years, and you've got to replace it. Could you just take us through sort of like what the net book value is of a sort of like your Crestchic fleet compared to sort of the underlying market value?
Yeah, of course. So just to explain, we make most of the Crestchic hire fleet ourselves. So it goes onto our balance sheet at manufactured cost. So obviously, if we bought it from a third party, probably 30 or 40% higher than that initial recognition. And we keep a very simple 10-year straight line depreciation policy. But with 2 or 3 upgrades, which cost sort of between 10 and 20% of the original cost, these load banks are generating revenue for around 20 years each. Obviously, we're looking at increasing our spend on high fleet this year, but most of that is for growth, not for replacement. So we do have this difference between our depreciation and replacement capex. I mean, the high fleet is now written down to just under 6 million at the year end, the Crestchic high fleet. The original cost of that is around 30 million, and it's insured at replacement value of just over 40 million.
Right.
Yeah. The second-hand load bank market is buoyant at the moment, and where we've had the opportunity to buy back some equipment, see, with manufacturing capacity constraints, we've grabbed it with both hands. But we have been paying nearly the cost of a new manufactured unit, so that the second-hand value is very high.
That's really important to investors, and I would highlight that because effectively, as I understand it from your accounts today, your net book value just to the group on a what you're actually reporting is about £21 million, which I think if you divide by 30 million shares, you get to about 70p a share. But if you're actually saying that the net book value of the load banks is about 6 or 7 mil, and then you've got your market value of about 40, then that's effectively another £1 per share onto it, giving you an asset backing of about where the shares are of £1.70. But equally, when it comes to again to the investors, when it comes to valuation, what you're saying is that effectively Northbridge's replacement capex is a lot lower in reality compared to your extremely sort of like or your conservative and prudent 10-line depreciation policy. So when it comes to that, then in my own personal investor sort of perspective, it justifies a sort of like a higher premium on that, because the business is growing, and more, just as importantly, it has a lower, effectively, implied capex cycle rather than machines degrading every 3 years because it's got no moving parts. Now,
exactly.
Yeah. So just turning now to the Tasman update. It sounds as though you've now finished that one, Peter. It's sort of like almost done and dusted. You've got 4 million. You've completed, hasn't it? The Australasia deal, or the Australia New Zealand segment, about 4 mil. What's left, and is it now all systems go just straight on Crestchic?
Pretty much. The Australia New Zealand business is completed. It's under its new ownership. The bulk of the money is in the bank. There's a small amount of deferred payments coming through, which will come through mainly over the rest of this year. A little bit will trickle into next year. So that's good news. As you know, we exited the Malaysia-Singapore operations back end of last year. Again, the cash for that is coming in over time, but it's all been received on time to date. So what's left there basically is the small operation we have in the Middle East. We're going through the process on that at the moment. Actually, this is the timed it remarkably around about our results announcement to get the indicative non-binding offers, and they are coming through. We've received 2 to date, and we're expecting more. We've not factored in a huge amount of value for the Middle East operation, and we're confident that we will get a good exit for that over the coming months that will be in line with what Iwan's provided in the accounts. It's not taking a huge amount of time. It's a well-run business. It runs itself with a little bit of supervision, and the transaction should be relatively straightforward. So the vast majority of our attention is now very firmly focused on Crestchic and its growth agenda going forward.
Great. Well, now, obviously, you've just increase the coffers there of Iwan, and he's done a fabulous job over the last 2 years during the pandemic, because he's had a really good, he's whittled away at the net debt, and I did see it's just slightly less than £1 million as at the end of 2021, which we were still actually in the Omicron variant. So what are you going to do when we're out of this COVID scenario? and now, I mean, I'm a bit of an idiot, but if you've actually got an extra £4 million on, from your Tasman, then presumably you're in a net cash position. So big question, Iwan. What are you planning to do with all this money? Obviously.
Yes, the net debt did drop to just under £1 million before IFRS 16 leases at the year end, and now the 3 million from the Tasman deal has come through, with the rest going to trickle through the rest of the year. So we are slightly in the net cash position at the moment. So we've got the rest of the factory to pay for. Most of that came through in the first quarter, and then once that's up and running, we'll be using some of that extra capacity to build higher fleet, especially for the Texas depot that Peter's already mentioned, and just boosting the higher fleet across the world. Obviously, we've spent £1 million on share buybacks in the last couple of months. And we are looking forward to the resumption of dividends. So see, our aim there is to balance the needs of investing in the business and returning cash to shareholders. So we've declared the 1p dividend for 2021 performance, and we've declared our intention for it to be a sort of progressive dividend policy. And we are aiming to get to a 4 times cover sort of in the medium term. We will obviously be pretty prudent at the start, but that's where we want to get to.
Well, I was just doing the maths myself, and I've updated my numbers, and I'm getting to an EBITDA for this year of roughly around about, this is pre IFRS 16, of about 7.7 million. And now if you're on a sort of like a relatively cash neutral position now, that gives you, at least in my just, maths, 15 million of debt capacity to do whatever you want, as much as not quite as whatever you want, because I don't think shareholders would be too happy. But obviously you're doing the organic growth. Is there any M&A at all, or is it really just all systems go on your own business?
Yeah, I think that's what we are focused on at the moment. But we're always open to opportunities for M&A. But I think, as you see, our strategy is a lot more focused at the moment, and that M&A would need to fit right into our current strategy and in the space that we're in at the moment. Great.
Now, just long-term picture, putting all this together, Peter, what is sort of the board's ultimate goal for the size of this business? Because let's just say you exit it just south of 30 million turnover. And I think you were doing return on capital employed of about 18%, etc. Just in about 5 years, nobody's going to hold you to it. But just what hypothetically, how big or large and sort of like how margins would you hope the business could get to?
Okay, well, firstly, let's just touch on that return on capital, because that's really important. And I know you mentioned it earlier, but yeah, we're back up to 18% at group level now after corporate overheads as a result of last year's performance. You've seen what people are tipping us for this year, so that'll push it up further, even with all the investment we're putting in. So we've upped our internal targets to a 20% return on capital, which is significantly in excess of our cost of capital. So that means in all the theoretical definitions, we're creating significant value for shareholders, which is what we're all about. And we don't intend to dilute that return on capital. Every investment decision we make now has that return on capital as its hurdle rate, and we look at it very critically, and we're not going to invest and dilute returns. But we're in the blessed position that we have a lot more opportunities to invest than many. We've got so many growth opportunities open to us. So if you look then, where will that take us on the grounds that we've got as many opportunities as we realistically need to grow the business? We've got a core market of load banks, which the best market intelligence we can get says is growing at over 5% a year. And we're consistently outperforming that. And the plans we've laid in terms of our ability to benefit from the high growth sectors in data centers and energy transition, which are hugely helped by the fact that we've got design capability, manufacturing capability, and we can respond very quickly to changing needs in the market. So that gives us a leg up on most people's ability to get market share. The geographic opportunities we have are significant. So, we aim to significantly outperform the market for the next few years, certainly getting ourselves up into double-digit growth just on the back of that market. And then on top of that, the most obvious identified sort of parallel opportunity is transformers. We do quite a lot of transformer work directly aligned with the load banks. We've got our own what we call packaged transformer business in Antwerp, where we rent transformers out in a very similar basis to the way we rent load banks. And that's a business that can grow noticeably. And the size of that packaged transformer market is probably actually bigger than the size of the load map market. So wow. That's another real growth opportunity for us over the next 5 years. So, taking all that into account over 5 years, this is not a forecast and you can't hold me to it, but we'd be pretty disappointed if we weren't at least twice the size we are now, still with the same level of returns on capital. And actually, with margins at least where they are today, if not better, but having used some of our manufacturing efficiencies and scale to pass some of the benefits back to customers. We believe in that. We believe that's the right thing to do to protect our competitive position.
Yeah, getting the economies of scale. I would just point investors. I mean, I've run the numbers just on that, and I'm sort of like forecasting a sort of 12-13% organic growth for the next 4 to 5 years, with a sort of return on capital employed, which I think you should target around about sort of 20%, etc. And when you do that, and then you use the multiples that I've suggested, which is about a 9 to 10 times EV/EBITDA multiple, simply to justify the extra growth and obviously the reduced replacement capex with regards to the actual depreciation. When you use that, then you get a sort of like a valuation of between £2.45 and £2.70. So significant upside there for investors to sort of chew over. And that is slightly different to the other broker notes. But I would suggest that investors have a look at that sort of like replacement capex stroke depreciation cycle, because it looks like a hidden gem, certainly, which hasn't been sort of like reflected in the to me anyway. So just
you're absolutely right on that. And if I can just re-emphasize that point, I mean, I think we're an intrinsically cash generative business, and that's what fuels our growth. You mentioned, we've got 15 million debt capacity on your numbers, so don't let me argue you out of that. I think it's a really sensible calculation. But at the moment, we're getting the growth we're getting without having using any of it. So that's just firepower in our back pocket, basically, if other opportunities come along.
Yeah, well, your biggest shareholder, Christopher Mills, knows a few things about sort of valuation. So I'm sure that's one of the reasons why he's been sort of like gradually adding to his position over the last few months. Just concluding then, Peter, just on the news flow going forward, we've got the AGM in June. And presumably you're going to give us a sort of like a bit more of a flavour in terms of, trading and hopefully, the Tasman is finally finished.
Yeah, I mean, June's not far away. I think Tasman at that stage will probably be in the last knockings of documentation. If we can get it over the line by then, fantastic. But that's pretty unlikely. These things always take 10 times as long as any normal person would think they do. But we'll certainly push on to get it behind us. But we'll give an update on that. We'll definitely give a trading update. It's another couple of months under the pipe. By the time we get to the AGM in June, we're pretty clear on where we're going to be to the end of the third quarter and getting some pretty good insights into the fourth. So we'll definitely give an update on trading around then. We'll be confirming that the factory is about to come on stream or has come on stream. And we will be inviting people up either at the AGM or more likely immediately following the AGM for an official opening of the factory.
Good. Well, I'm sure you'll get a lot of people, myself included. So well done, guys. Well done, guys. Great teamwork. I mean, you've hit all the cylinders there, both top line, bottom line, improving margins, and effectively the growth trajectory is very, very well underpinned. So fabulous job, guys. Keep up the great work, and I look forward to touching base in June for the AGM.
Sounds great, Paul. Thanks for your support. Thanks,
Paul.